All right, welcome to another week of the Educated Homebuyer Live. Before we get too deep into this, let me know that you can actually hear me on this microphone here. I'm having to work from home, so I am just making sure that you can actually hear what I'm saying, because if you can't, we need to change something. So just give me a 1 in the chat or tell me if you can hear me. That would be helpful. Hello, hello. I know we got Jennifer Lego there. Thanks, Jennifer, for stopping in. Let's see what we got here. Can anyone hear me? Sounds good. Awesome. All right, guys. So this week, we're missing Josh. So kind of back to old school like we were a couple of weeks ago. Josh is traveling. He's in Detroit. He'll be back next week and be able to do our thing together. This week, it's just me. I'm going to update you on charts. We're going to walk through what's happened in the economy since last week. We're going to answer your mortgage and real estate related questions. So if you can start putting them in the chat now, that would be helpful. That way, when we come out of this, it just flows nice and easy and you get your questions answered. So the sooner you are, kind of go in order. So the higher up you are, the more likely it's going to get answered throughout the show. But this week we had, since last week, we've had employment data. We've also had CPI as of today. So we got a lot happening out there, which we're going to touch on in today's video. But with that said, I want to start with the title of the video. So Fannie Mae's predicting lower rates by December of 2025. So Fannie Mae came out and updated their forecast, I don't know, a couple of weeks ago at this point, and dropped their forecast to 6.1% by the end of 2025. And they actually set another forecast for 2026 as well, down to 5.8%. And the thing to note with these is it wasn't a huge adjustment in their forecast, but it was downward, which was actually quite surprising, just considering where the market is at this time. And so, with that adjustment, the thing to note here is that 6.1, we're currently, as you're going to see later in today's video, or, in the charts when we look at them, we're somewhere around 6.75, 6.8% for most well-qualified buyers out there. So it's a drop of almost 0.75%, which is a huge drop from where we are, but it's not the 5%. It's not the 4% that a lot of people out there are looking at. So the lower rates that we're all hoping for, it's probably going to be more of a grind, something that we've kind of talked about consistently over the last couple of months, at least, that, we are predicting lower rates, but it's not going to be this huge drop unless we see something major, probably on the employment front more so than the inflation front. And you're going to see what I'm talking about as we continue to look through these charts. So we like to start always looking at inventory. And this week, we saw inventory continue to increase. So our weekly change took us from 803,000 unsold single family homes up to 808,000, which is a 32.2% increase year over year. So quite a bit higher than we've been in the last 5 years. But as you can see from this chart here, we're still below that 2019 level, which again was a more normal market. Doesn't mean that there aren't price corrections out there. It doesn't mean that there aren't some markets that are adjusting faster. Just the reality as a whole, as a nation, we're still not back to normal levels in many markets out there. Taking us into where we are here in Orange County and Huntington Beach. So Orange County sitting at 4,660 listings. This is the highest amount of listings that we've had on the market since I think June or July of 2020. So it's been quite a while since we've seen this many properties on the market. Now here in Huntington, we dropped to 288 listings. So that's a small downtick from where we were last week. But Orange County up, 2.94% week over week. And Huntington Beach actually down just over 1% week over week. So not a big movement either way. But the reality is more properties on the market, staying on the market longer just because of affordability, higher rates, part of it seasonality. This is that time of the year where things do tend to sit a little bit longer. Just because it's, people are out on vacation, kids are getting out of school, just parents are doing other things other than shopping for homes in many markets out there. This is just another chart, same look at inventory. The difference here is that they also include properties that many times, I'm not 100% sure how Realtor.com does it, but some of them include pendings as well as properties under contract. So the number's slightly higher with than the 800 and what do we say, 809,000 or something. So just if the number's off a little bit, it's just because of how they calculate. They just use different numbers or different properties rather in that number. But you can see, going back, 2017, 18, 19, yes, we're increasing, but we're still below those normal markets, putting us into new listings out there at the moment. So kind of a tough week for new listings. Even though we're up slightly over last year's numbers, we haven't quite got the rebound we wanted after the Memorial Day weekend. So last year's new listings peaked around 75,000. This year, we've actually surpassed that, twice. But we have about 4 to 6 more weeks of seasonality where we could get above that 80,000. But I mean, the key here is to avoid what happened in 23 and 24, where we basically stalled out in midsummer. So expecting more listings, but depending on what happens out there in the market, that could, potentially impact that a little bit, which would keep listings on the lower side and, basically keep prices more stable pretty much across the board. So this is a chart just taking months of supply in different markets out there. I mean, you hear a lot about Miami, you hear a lot about Texas. I mean, when you look at the top, 6 there that are in red with regard to months of supply, they're all in the South, Louisiana, Florida, and Texas. And, why are these numbers important? The more inventory that you have, where buyer demand's more or less the same as it was last year. The biggest difference is we have more listings on the market. That's why prices are, going down in many markets, or in Florida and Texas, and stabilizing in many other markets out there. But the 6-month mark has historically been where, the market looks at it as a seller's market. I think that's kind of old school thinking at this point. I think, you could be in a seller's market in some markets with less than 6 months inventory, just depending on the price point that you're in. But nevertheless, looking at this just gives you an idea as you move forward. The toughest markets out there, Columbus, we have people comment on the videos all the time. Hey, I'm in Columbus. The market's crazy here. Yeah, you only have 1.7 months of supply. That's why, there, Santa Clara, Indiana, New Hampshire, Albuquerque, Grand Rapids, all of these markets have low supply, which is creating that pressure that you see. But anyhow, take a look at that chart, and I guess let me know in the comments which of these markets surprises you the most. That would be something that I'd be interested in hearing. So taking a look at weekly pending sales. So weekly pending sales slightly above last year. We were at 69,363 last year. We're at 67,649. So just slightly above. Nothing really to talk about. As I said, demand's pretty much the same as last year. The biggest difference is we just have more property on the market. Total pending sales, that we're mirrors last week, up 2.6% on last year, and came in at 402,833. Last year we were at 393,632. So just shows you we have a little bit more activity than we did the same time last year. And price reduction still headed higher. 39% of all listings have had some sort of price cut, and basically near decade highs with regard to price cuts. So important to note. But it's also important to know that real estate's local. So pay attention to what's happening in your market. Don't just see this number and say 39% of homes have a price cut. Therefore, every seller must be willing to cut their price. No, not necessarily. But also understand at the same time, some of these price cuts might be 5%, 10% in some crazy markets out there. Others, it might have dropped $100 and they're part of that statistic. So it doesn't have to be a certain amount to be a price cut, but the reality is just over a third of homes out there in the market have some sort of price cut on them. Josh threw in some charts here. Basically some dealing with the deficit and some other things out there, but this just shows, what the estimates for the House bill looks like with regard to, the next couple of years being and what that impact actually looks like to the deficit. And that's going to take us into looking at this chart, which is just showing, it's a seasonally adjusted, but it basically shows that the interest that we're paying now on our federal debt just the interest alone has surpassed the defense budget that we have, which is absolutely nuts. So as we get more and more debt, this number is going to continue to go higher and higher. It's not sustainable at higher interest rates. It just isn't. That's one reason for the last year and a half, 2 years, I've been saying we have to have lower rates. The government needs lower rates, because the lower the rates, the lower the interest they're paying on their own debt. So, as that number goes higher, it's actually impacting them, as much as anyone, just because of the amount of debt they actually have. So this is a problem that's, been out there for what? I mean, it's continuing to go years and years, and nobody wants to address this. Nobody is willing to take this on just because of the magnitude. And the reality is, saying that you're going to tackle this probably isn't going to get you elected, because this means, spending cuts. This means taking away programs that people find helpful and beneficial, and all of that good stuff. So something that needs to be tackled. The reality is, I don't know when that actually happens. And this, again, just shows a percentage of increase in U.S. national debt. I'm going all the way back to 2001 with George W. and then through Obama and Trump and Biden. And you can just see what that increase looks like now. The Bush and the Obama had 8 years, right? So not really a fair assessment there when looking at the compared to Trump and Biden, who both did 4-year terms. But either way, all presidents, regardless of Republican, Democrat, what have you, are doing the same thing, which is spending money and adding to the federal debt. Non-farm payrolls came out last Friday. Numbers came in a little bit higher than expected, but at the same time, we saw them revise numbers from last month, which again, it kind of helped offset that a little bit. But the chart that Josh threw in here, I'm not sure 100% where he was going with it, but just shows that we've been up on an upward, for 53 basically months in a row. We've had some sort of positive addition to jobs. And when I look at this chart, what comes out at me is 53 is on the high side of consecutive months when going back in this chart. Now we had that one crazy period between 2010 and 2020-ish, right? Where, we had 113 weeks, or months rather. 50, you take that one out, 53 is on the high side. Now that doesn't mean that we can't go back up to the 113, but at the same time, if you were to take that piece out of the equation, it looks like we're probably getting towards a peak, and we could see those numbers move down. And if you want to see lower rates, you in theory want to see lower jobs created, because that essentially just means a slower economy, and a slower economy will lead to lower interest rates. Again, looking at the non-farm payrolls year over year change, still positive at 1.1% based on this chart. Again, not 100% sure where Josh was going with it. U.S. employment rate sitting at 4.2% currently. The lows we saw was 3.4 back in 2023, but the average going all the way back to the late 40s, early 50s is about 5.7% on unemployment. So we're still well below that. The Fed's target has been 4.3% is kind of what they threw out there as to when they would start making adjustments potentially. So we haven't gotten that yet. There's a chance that we see it in the second quarter. And I think that's one reason that maybe Fannie was predicting potentially lower rates at that time. So this just shows U.S. inflation rate month over month. This is I believe the headline number is what we're looking at here. So as we've discussed before, we had a zero fall off from last May. We replaced it with a 0.1. Which again shows that inflation would tick up, but the good news is it actually came in less than expected, which was a huge positive for the market. So currently sitting at 2.4%, whereas last month we were at 2.3. Again, 0.1s across the board gives a 1.2% inflation rate. So that's positive. That's a good thing. We just need to continue to follow it. And then this is the 10-year. I don't like Josh's 10-year chart, but it is what it is. So this just shows, Yeah, we've basically been in that range that we've been in for some time now, with the high 4.6, lows kind of sitting there in the 4.1, 4.2 going back to early May. We're at 4.4 today. Market reacted pretty positive to the inflation data, which was what we wanted. But the reality is there's not really a lot at this point, I think, that's going to move the 10-year and or rates, unless you get a deal with China and deal with some of these countries that actually a tariff deal where it looks like inflation is not going to be a long-term problem, because that could impact interest rates in a positive way. Interest rates today, per Mortgage News Daily, sitting at 6.89%. That's what, 0.02% up from where we were last week. So basically the same, down a little bit from yesterday. And basically that 52-week range, 6.11 to 7.26. So towards the higher side of that. But the reality is, if Fannie Mae is right, we're going to see lower interest rates by the end of the year. That QR code will get you to the Rate Watch, jebsmith.net/rate watch, which essentially is allowing Josh's team to just watch rates for you. If you're thinking of refinancing and taking advantage of that, he'll just do the work and update you if and when rates get down to your target number. All right. It's really, really hard to talk by yourself, guys. It's especially when you're just staring at a camera on the other side. So it is that time now where we're going to start answering some questions. We're going to take your, hold on here. Whoop. And that's all the states that Josh can help. Anyhow, here we are. So I'm in spare bedroom / office / playroom at the moment, to help guide you guys, answer some questions. Not a lot in the chat at the moment, but we're going to start up. Let me know where you're watching from. Let me know if there's a question you have, because I am here to answer it. And if we don't have a lot of questions, guess what, guys? I'm just going to pick up and go spend some time with my family. So Jennifer Lego popped in. Jennifer, longtime subscriber, longtime helper, friend of the show. Good to see your name there, Jennifer. It's been quite some time. We've got Dixieland Production coming in from Minnesota. Appreciate you there. Sam is in the house. We got Willing in the house. We got Leanna. Leanna is asking, is it a good idea to take a HELOC for a home edition currently sitting at 5.99 on a VA loan and eager to get started, then hopefully refinance if rates drop? Is it smarter to wait? It depends. It depends on the situation. So HELOCs are one of those things. How much are you going to take out? And what's the balance on your first mortgage, right? So with a home equity line, you're typically going to pay a higher interest rate than you are on your first mortgage. I can't speak to exactly what that rate would be, because it depends on loan to value and a factor of other things, but probably looking 8.5% or more on that second mortgage. So depending on how much you're taking out versus your balance on the first, the reality is interest rates for a VA loan aren't that much off of what you have at the moment. So it could be one of those things where it makes more sense to refinance the entire amount using a VA streamline, because of low documentation, no appraisal, all of that sort of thing, and take the entire balance. And in that way, you lock in a lower interest rate on the entire thing versus having a 6% and an 8 something on the second. So it really depends on that. But what I would say is use that link scrolling the bottom there, jebsmith.net/start. Actually that won't, that'll work. And you can reach out to the team, and Josh can answer that question directly for you if it's something that you're actually considering there. All right. Let's see. We got, hi, my name is Tim in Queens. Pop Keys is on Fontana. Let's see. All right, guys, there's not a lot of questions. So what are we going to do tonight? What do you want to talk about? We can talk about anything, but you guys are here for real estate. So if you have real estate or mortgage questions, pop them in. I want to see if I can provide some value for you. And go from that. So Leanna came back and said, is a VA streamline different from a cash out refi? I'm not trying to hog the chat. Listen, if you're the one answering questions and the only ones here, I'm happy to you and I can talk, Leanna. How's it different? So typically a cash out refinance requires income documentation, requires appraisal, basically just like getting a regular loan. You have to go through all of that documentation. Whereas a VA streamline requires no appraisal, no very little documentation at all in order to go through that process since you're already a veteran. So that could be a huge benefit and save you some time and some money going through that process. All right. Wesley asks, where's the numbers guy? Showed up late. Dude, you missed him. Got fired on the spot. No, Josh is in Detroit at UWM, United Wholesale Mortgage. One of the brokers they use, just I think some training, doing something up there, but he'll be back next week. Willing, how do you explain closing costs to borrowers? Why do they exist? Why do closing costs exist? Because people need to get paid for doing their job at closing, right? So there's multiple parties involved. There's a title company, there's an escrow company, sometimes there's attorneys. These people want to make money for doing their job. So that it basically comes across as closing costs. Nice thing about closing costs is you only pay them if you close, right? So if you're not buying a house, you're not paying the fees, typically speaking. So you might pay an appraisal fee, or maybe a credit report fee or something like that up front. But with regards to title and escrow fees, that sort of thing, you're only paying those if you actually close. How do you explain it? It just basically, so escrow is what we use in California. Some other states use title companies, attorneys, that sort of thing. But basically an escrow is a third party representing both the buyer and the seller, right? They're there as an intermediary just to make sure everything is by the book, is done correctly. So, there are fees associated with that. Typically, to be honest, you don't really have to explain closing costs so much. People understand them. Now, different people call closing costs different things. When you're getting a loan, the lender that you're using might, have different fees listed as part of their closing cost. So some of them are junk fees, but typically speaking, the main closing costs, title, escrow fees, that sort of thing. And then you have prepaids, which are, taxes, insurance, that sort of thing. So I'm not sure I really answered your question there, but hopefully that's helpful. So I made a mistake, guys. I came here, sat down with absolutely no water, and my throat is killing me. So we're gonna text my wife and ask her to bring me water. But while I'm doing that, do we have any more questions? Can I help you guys? Let's do this. We're 25 minutes in. 55 or so of you watching. VAG Sports Highlights. VAJ, can you borrow from the equity from your rental to buy another rental house? Absolutely. Yeah, you can take cash out of a rental property, but understand, because it's an investment, because it's a cash out, the interest rate is likely going to be higher than you probably want to pay on that property. Cash outs on your primary are obviously a lot less expensive, but got to do what you got to do. And the answer to your question is yes, you can do that. Thanks, bro. All right. Adios. All right. So, all right. Got a water. My son brought me a water. So we're good to go again. Okay. Let's looking at the questions here. Willing asked another question earlier. How do you win a jumbo loan deal? You have good terms, good interest rates, right? That's how you win all business, good relationships, all of those things matter. But for most borrowers, they're looking at interest rates, they're looking at terms, as well as communication, that sort of thing. How should I pay the homeowner's insurance premium on top of the escrow in the closing? So, Typically speaking, like when you close on a property, you have to pay the homeowner's insurance policy, the premium for the entire year. So that is going to be required at closing. I don't know if you're saying, should you pay it before closing or whatever? Either way, it's going to be paid at closing. So whether you pay it before or after, it does need to be paid so that you have insurance on that property for the year. Is this it, guys? Is this it? I'm not sure if any of you are aware. Most of you guys here, I think, are buyers looking at the market. But I created a new channel here on YouTube called How to Sell Your Home. It actually is just taken off. It's over 1,000 subscribers now within the last couple of weeks. It's something I started this year just because my main channel, this channel is primarily talking about how to help buyers. So if you're a seller out there, somebody considering selling a home, or know someone in it that is, make sure they check out that channel. Pretty informative. But again, it's just dealing with the selling side versus the listing agent side. So, I mean, versus the buyer side. Leanna came back. Do we do Oklahoma? So if I look at this map here, let's see here. Oklahoma is one of the states where we refer it to David, who's one of our lending partners. So we can definitely help. It just wouldn't be Josh directly. So if you need that assistance, make sure you reach out, and happy to connect you there. Tom says, thanks for always providing clear, informative content. Any thoughts about engaging a real estate lawyer in SoCal for a first-time home buyer without a realtor? First visit was without a realtor. So I'm assuming you're talking about yourself. Why do you need an attorney? I mean, is it you think you're going to pay less? Here's the thing is, like, in my experience, most sellers are paying compensation. And if you are a buyer coming in thinking that because you don't have an agent, that the seller somehow are going to discount that price, what I'm finding is the answer is no, because what happens is when you don't have an agent, somebody still has to do all of the work that your agent would have done, which is typically the listing agent, which means the listing agent then asks the seller to be compensated for that additional work. So the listing agent just makes more money on these transactions. So I would advise, I mean, you can definitely use an attorney. I would not try to represent myself. I mean, I just had a transaction where the buyer tried to do that, and the contract that was written, the terms were crazy. Like my seller was never going for that. Some of this stuff. So anyhow, just my 2 cents. But I think representation is important for many reasons. Pop Keys, we went through escrow, close, received the final document, explained the fees and breakdown of the loan and fee. Then we received a check. 1 week later, escrow calls and wants the check back. So what's the explanation? What's the explanation on the check? Did they calculate something incorrectly? Like that escrow, that final closing statement should balance, right? It has to balance for them to close, and then the money gets sent out. So where's the discrepancy? That's what you need to figure out. It's hard to say without actually knowing what's going on there. Could that channel supersede this channel? 2 lives every week moving forward? No, I don't think it definitely won't I mean, this channel is 120 something thousand subscribers. That one's 1,500. So it's got a long ways from becoming this channel. And the goal with that channel is not to become 100,000 subscribers. It's basically just to help sellers out. So I don't know that we'll do a live there, but I might at some point, just depending. Raul, if I buy a primary home, a conventional loan, that means 3 to 5% down. Can I rent it out after a few months, or do I have to wait at least a year, or can I sell the house within a year? So there's no specific time when you sign your loan documents that says I'm going to live in this property for this amount of time. That being said, you're going in with the intent to occupy that property as your primary home. So there's nothing to say that you can't do it a few months after, but you are signing it basically saying it's going to be your primary home. So do what you want to do there. As far as the waiting a year, that's just kind of this unwritten rule that people have created. You got to wait a year. You don't have to wait a year. You could literally do it 2 months after buying your house. In fact, you could do it right after buying. You could just say, I'm going to live in it and rent it out. You can do that. But you are signing documents that says otherwise. So, and yeah, you can sell your home at any point. You can buy a house today, sell it tomorrow if you want. Just understand there are costs associated with that. All right, Taryn, how do you formulate an offer on a house in a correcting market so you don't overpay? Houston, you find a good agent. I got a great agent in Houston. In fact, a couple of them, in fact. But what is the correcting part of it? You still have to use comps. But if you're in a market where prices are moving downward, then you can factor that into your negotiation. Just like when we were in the middle of the pandemic and properties were selling higher and higher after every single offer, we were just trying to figure out what that price increase was. How much was it increasing over the last offer? You could do the same thing in a declining market, right? Is just figure out what that number is. But I would encourage you not to get caught up in trying to pick the top or the bottom. It's not the right way to buy real estate. You should be focusing on whether or not the payment makes sense to you now. Can you afford it? Do you have a longer term time horizon? And time will take care of itself, right? I mean, could you buy and it move lower? Sure. You should, absolutely. But you could also wait to buy and then things start moving up and you never hit the bottom or never buy at all. And that's typically what happens, right? People are waiting for lower. And then all of a sudden it goes up and they go, well, I'm just going to wait for it to move back lower again. Well, then it goes up for another 10 years and they go, what happened? So that sort of thing can happen. Again, talk to a good agent in that market. You can use that link scrolling at the bottom of the screen here, jebsmith.net/start. It'll get you in touch with me. Can make that introduction if you need somebody there. But either way, just have those conversations with people that understand real estate and not some troll on YouTube trying to, pitch their agenda for, because they missed out on, opportunities. Anyhow, hope that's helpful. Jay Holiday, we made an offer on a house that has been on the market for 28 days, no offer. So we made an offer for 10K below asking, and they countered 5K over asking and only wanted to pay 1.5% to my agent. Seems a bit crazy. Could it happen? Sure. So why would an agent counter you higher than your original offer? Well, maybe they're building that compensation that you're asking for into that higher price. Maybe they said, hey, listen, we're not willing to lower our price below this number, but we were going to pay 1%, compensation at that price, but you want an additional 0.5%. So we're going to raise the purchase price in order to cover it. I mean, that could be the way that my brain works logically. Could it be just somebody irrational? Sure. It could be somebody that doesn't understand that piece of the negotiation and they're throwing out random numbers because their agent didn't educate them. But 28 days on the market at the moment, it's not a crazy amount of time. I know a lot of people out there think that's a long time. It's not long. Like, it's still a seller's market at 28 days. I think anything below like 60 something days is a seller's market. So just because it's been on the market 28 days and didn't sell in the first weekend, that's okay. Like, that is normal in today's market. Most people only remember the last 5 years. There's going to be out there that don't know what to do because their homes aren't selling. They're not used to these conversations, these tough conversations. I mean, I've been in a market where homes set for over a year and a half in some cases. Those suck. So again, doesn't mean they shouldn't accept a lower price, but at the same time, it's not a crazy amount of time. So, and 10K below is not, I mean, that seems reasonable to me. Raul, what's the difference between a counter offer and a backup offer and an escalation clause? So counter offer is when you submit an offer and the seller counters back, right? They come back with different terms than your original offer. That's a counter offer. A backup offer is when the seller says, hey, yeah, we're accepting your offer, but we already have another offer that we're working with. So we're going to put you in backup, right? We like your offer, but we're already under contract. If something happens, we'll call you back. That's kind of the backup offer. And then an escalation clause is when you submit an offer on a property. Say, for example, the home's worth $500,000 and you're willing to pay $510,000, for example. You're willing to go over the asking price. Well, you could write an offer for $500,000, build in an escalation clause and say, hey, listen, this is my offer today, but if another offer comes in at whatever you determine that number to be, say, whatever, right? If somebody comes in willing to pay more, you're willing to pay more than them, right? So an example would be my offer's $500,000, but I'm willing to pay $500 above the highest offer up to 510. So it kind of gives yourself a built-in counter going up to a certain price. Some sellers, agents don't like them. So just know what you're working with. What's the difference between a private appraiser and an appraisal agency? A private appraiser, somebody who just works independently, like, they're just self-employed, typically speaking. Maybe they own their own business. An appraisal agency is an agency that has appraisers working for them, right? In some cases, that private appraiser might actually work for that company too and do appraisals on their own. But either way, one is a company with several agents or appraisers, and one is typically, you're just talking about one person there. Are borrowers protected from getting their EMD back if they can't get final approval from underwriting and it's past their due diligence period? So in the state of California, the way the contract's written is you have 17 days to release contingencies on everything. But it has to be done in writing, right? So the 17-day contingencies don't just fall off. You still have to sign a document saying, hey, I'm releasing these contingencies. So answering your question, if the loan didn't get full approval, say, for example, I got declined and that loan contingency is still in place, even if it's after the due diligence period and hasn't been signed off, then the EMD is still protected. Now, in which case they've signed off on contingencies, they've released that loan contingency and it doesn't get underwriting and now they can't get approved, then in that point, in that time, that their earnest money would be at risk. At least that's how it works in California. Different states do different things. How do you counter with an offer over asking that's playing games? Hard to say, right? I mean, again, without knowing the terms, I can't tell you specifically. But put your best foot forward, right? There are definitely unrealistic sellers out there, and there are sellers that are willing to negotiate. And then there's some in between, right? There's some somewhat unrealistic, but also want to negotiate. But typically it has to do with a little bit of guidance from their agents. Sometimes sellers just want to do their own thing and not really give the agent, any potential say in suggestions, if you will. So it's, without having specifics, hard to tell you really. Anyhow, that wasn't a question for me. Well, that's even better. I just wasted 3 minutes talking about that. Okay. Josh didn't make it today. Question mark. I have a few mortgage questions. One question for you. I don't have an agent with the new rules last year. Can I still go to open house to see without an agent? Yes. Yeah, for sure. Put your mortgage questions in here too. I might be able to answer them. Yeah, you can go to an open house without an agent. Absolutely. In fact, you shouldn't even have to sign anything when doing it. So you can go to open houses and do whatever you need to do. Have I ever had a client lose their earnest money deposit? I have not. I've been doing this a long time and never had anyone lose their deposit. I do know of agents that have had clients lose it, and I know of agents that have had clients walk away from their deposit willingly because they wanted to move on and didn't want to move forward with the transaction. So it does happen. Just when you do your job right, it doesn't happen. So fortunately, I'm in that doesn't happen camp. What is a rate on an investment property high credit score? I have no idea. I haven't done a loan or seen investment rates in quite some time, but I would probably think high sevens somewhere, potentially even higher than that. But again, loan to value, credit score, all of those things matter on that. And that would be a good question for Josh when you come back. If you have a borrower who has multiple businesses, do you have to include all of them? What's the first thing you do when you review tax returns? So, so do you have to include all the businesses? So basically what's going to happen is you're going to provide personal tax returns. Those personal tax returns are going to show that there are businesses, right? Because it's going to show up on your personal return. And then you're going to open Pandora's box. So I can't say 100%, but yes, I think all businesses have to be documented at that time. And then because it all bleeds through, it all comes down to on your personal. And so that's what the lender cares about, right? They don't care how much your business made. They care at the end of the day how much you made, and what's being written off and all that. So what's the first thing you do when you review tax returns? You go through it line by line. Start on page 1 and go through. And I haven't had to review tax returns in a long time, but yeah, it's an art for sure. And I would say most loan officers out there don't know how to do it correctly. So Jay Holiday, the house we put an offer in was listed for $685. My lender told me they bought it in January 24 for $635 with 5% down. So it seems like they wanted to make up the money. So here's what I would ask you: who cares what somebody paid for a house? It bugs me when people get caught on that. Like, who cares what the seller paid? Maybe they got a deal. Maybe they didn't, right? Maybe they added some things to the property and increased the value. Maybe the market went up. Like, all of these things are reasonable things. So don't get caught up in what someone paid, right? Just what's it worth? Like, use comps, and that's how you come up with the value of a property. It has zero to do with what somebody paid for it. And how you get to the bottom line. Are ARM loans getting more popular? Last time I checked, ARMs were pretty close to fixed in mortgage rates. Just want to see if ARMs have better rates now. Yeah, ARMs are very popular at the moment. 7-year, 10-year ARMs, interest rates are probably 0.5% or so better than most market rates out there. In fact, I have a buddy who works for a bank, and he told me last week 5.75% on it was either a 7 or a 10-year ARM. So yeah. Yeah, the ARMs are definitely popular. There's a good opportunity out there right now with ARMs, just because they're pricing them accordingly. If I'm qualified for conventional loan and the FHA offers less rates, which one do you recommend to go with? Do a side-by-side comparison, right? Get the FHA loan, get the conventional loan. What's the monthly payment look like? What's the cash to close look like? All of those things are important, right? There are some downsides to FHA, but at the same time, look at the bottom line and make your decision based on actually reviewing the two side by side. That should help give you the guidance that you need. Can I refinance a property that has an investment loan with a live-in loan? Can I refinance a property that has an investment loan with a live-in loan, like refinance it so that I will be living in the, okay. So can you refinance it to an owner occupied loan? Got you. That's what you're asking. If you're living in the property and you can document that, then yes, you should be able to do it as refinance it as a primary loan. I will be honest, that's probably, when I owned a mortgage company, I don't know that I've ever had anyone do that. Be interested to see if Josh has. But in theory, you should be able to do that as long as you can prove to it. It's got to make sense to the underwriter, so on and so forth. How many payments can you miss until a bank comes after you? Depends on the bank, depends on state, all this stuff. But typically speaking, 90 days. 90 days is when a notice of default can be filed, at least here in the state of California. Other states might be different, but just make your payments, so you don't have to worry about that. You don't want people chasing you on your mortgage, right? You need a place to live. Is it worth to refinance my 7.449 mortgage rate at this time? Could be, depending on what the balance is and how much you're actually financing. Could be a great time. Also depends on the loan type, equity. Like you need a full picture, right? But interest rates right now, depending on the loan, the amount, all that stuff, down 6.75-ish. So what, you'd be saving about 0.75%. That's probably worth it, depending on your loan balance. But it definitely something to look at. That link scrolling the bottom, jebsmith.net/start, will get you in touch with Josh and the team, and he can walk you through that process. Let's see. All right. Not a lot of questions tonight, guys. Not a lot of questions. Got this one hair sticking up right here. See this thing? At least, and it's thinning. It's thinning, guys. This is not good. Like, I never want to be the guy that has thinning hair, but it's thinning. Anyhow, that's enough about that. Question about protecting home from probate. So, what's better, a trust or a quitclaim deed or a ladybird deed? So, in my experience, I mean, a trust is the best. The trust is the best option for sure, because with a trust, you can avoid a lot of things, when passing it along. And so that's one of the benefits of a trust. Um, anybody that owns a home that has any heirs at all, like somebody you want to leave something to, should own, should have their property in a trust. And so that it passes through, and, tax fits there. But in the state of California, I believe it just passed or is passing. If your home value is under $750,000 and you pass away, you can avoid probate. So you don't even have to do it if your home's under 750. But I think that there's other reasons that you should do it as well. You should try to avoid probate at all costs, just because it's expensive and it can be avoided, right? It's something that is avoidable. All right. Here we go. A couple more questions, guys, or we're racking it up tonight. Anything? Anyone? No? When will mortgage rates possibly drop a little? One analyst is predicting September. Again, hard to say. Like, September was the month last year we saw rates drop. It was nice. That was a nice little pop. I actually took advantage of it myself. But you need employment data to break a little bit. You need some pressure on those things. You need some certainty in the markets, on tariffs, on some of the, like, stability, right? Once you get some stability in the market, I think you could see mortgage rates move lower, into that mid-6 range. I mean, I don't know that I agree with Fannie Mae at 6.1%. Could I see it? Absolutely see an environment where that could happen. And I also see an environment where we're at where we are now. So hard to say, but I do believe there's an opportunity for lower rates just based on what it looks like to be a softening economy. You just need a couple of months of that data in a row for that to actually happen. Raul, which house is considered good? Off-grade house or a concrete block house? It is costly to do plumbing, electrical on a I know nothing about either of those. Everything concrete block. I'm assuming maybe you're talking like a raised foundation. Is that what we're talking about? I'm used to houses built on slabs, houses built on some sort of raised foundation, right? Houses built on slabs can be more expensive to work on, just because you got to run everything through the attic or what have you, or something breaks if it's in the slab, that can create issues. Houses that are built, on that are raised foundations are a little bit easier to work on, because you can run the ducting underneath, you can run plumbing, electrical, all of that stuff is pretty accessible. But I guess it all depends on what it is you're trying to do. But I don't know what an off-grade house is. Maybe you can enlighten me there. Are tiny homes going to take over, or barn dominiums? So tiny homes, are they going to take over? I mean, there's no world in which I would own a tiny home. Like, I got 5 people in my family. Like, what are we going to do in that thing? But I mean, I can see from an affordability standpoint, somebody wanting to consider that, but I don't think they're going to take over, right? I think we kind of saw this mass move, in the middle of the pandemic, people considering that. But since then, I haven't really heard a lot about it. Barn dominiums are rad. If you have the land for them, those are super cool. Would love one of those myself, but not going to happen here in California. This might be a tax question I'll ask you. If you own less than 10 investment properties, should I put them in their own LLC? I want to protect myself. I don't really have advice on investment properties and LLCs. If you go on YouTube, you'll have 100 people telling you every property should be in an LLC, so on and so forth. I think you really need to talk to, somebody that understands LLCs and investment properties and what it is you are protecting. Um, and go from there. I don't really have an answer for you on it. I've owned investment properties in the past. They were never in LLCs for me. I know people that do it. I know people that don't. Unless you got partners and that sort of thing, I don't know that there's a reason, but that's just my opinion on it. All right, guys, it is 5:50. You guys aren't jumping in and asking questions. So what I'm going to do is ask you a favor. If you have found any value, do us a favor, hit the thumbs up. Consider subscribing to the channel if you haven't done so already. If you're looking to sell, you can check out my new channel, How to Sell a Home. If you're not familiar with the podcast, The Educated Home Buyer, go check that out. Provide a lot of value on that channel with Josh, who is normally here tonight. But with that being said, if we could be of any assistance, jebsmith.net/start. Until next week, guys, make sure you're buying right, borrowing smart, and building wealth.